Hi everyone, I've received quite a few questions in my DMs about investments, so I decided to record a full video where I'll explain a bit more, basically how it all works, how it happened for us and so on. So here's how it goes. This is how it works. There are startups, and startups raise money for development in California. In general, this is very well developed in the US, everyone does it. So we decided to try it this way too. So what is it? The process looks like this. You have a startup, you have a legal entity. Most often it's a Delaware C Corp, which is the standard in the venture world. You register the company, you negotiate with investors, explain to them what you're doing, they get interested, they sign documents with you and transfer money to your company's account. They get a stake in it and that's it. Usually at early stages, this happens through a safe note. A safe note is from Y Combinator, which is an accelerator. They created this document, this piece of paper that allows you to handle all these matters more quickly. So you don't need to go through lengthy negotiations or sign a bunch of things. But well, in short, that's what this thing is. Essentially, it gives the investor the legal right to receive a specific predetermined share of your company stock at the exact moment when the very first formal valuation round takes place. That is to say, the first time the company undergoes a professional valuation. At that specific moment, shares at the originally agreed upon price are officially transferred over to the investor. This is common at early stages like pre-seed or seed because it's much simpler, that's the main point. We started working on Easy Vision at the beginning of 2025. So, we raised a bit of money from angel investors who knew us personally and invested their own funds. And we had a plan. We had a plan that we would work full-time until the fall, really focusing on traction, meaning selling, building the product, building the business, and then in the fall we would raise more money. So that was the plan, a conscious one, to raise money in the fall because from around September to December is the best season in California for fundraising. In the summer, people are often on vacation, and at Christmas in December, by the end of the month, no one is really working anymore. So fall is the best time. So that was the plan. We had everything prepared. Let me show you what we had ready, what we had prepared. We were incredibly fortunate to receive over 100 warm introductions from our close founder friends, and right here you can see every single one of those intros. We had meticulously prepared over 100 introductions to a wide variety of potential investors, which gave us the unique opportunity to focus entirely on building the core business, simply because we already had such a massive pool of connections ready to go. We already knew that when we started raising money, we would ask our friends, the founders, to make intros to potential investors for us, and they would do these intros and we would get some calls. Here it's considered that 100 intros is the bare minimum, meaning you should have 100 warm intros. That's where you can start. If you have fewer intros, that's not good. In general, there are two approaches to raising money. Here it's parallel fundraising and sequential fundraising. Sequential fundraising is when you are constantly, but rather sluggishly working on it. You go to a fundraising event, meet some investor at some event, you tell them your idea and say, well, do you want to raise money? Do you want to invest in us? And so, little by little, you do this alongside your business. The second approach is parallel fundraising. This is when you prepare the ground in advance, meaning you get to know potential investors ahead of time, arrange intros from fellow founders in advance, and then start all at once on a single day, fundraising. So you say, for example, my fundraising will run from September to December, or I don't know, it will last 2 months, September to October, and we will... During this period, we talk to everyone, and during this time, we close the round. One way or another, this is the smartest approach. Why is it the smartest? Because first of all, you don't get distracted, you're focused. So you spend the whole year working on the business, and then for 2 months you work only on fundraising. Because it's a full-time job. When someone is actively raising investments, it's a full-time commitment. We acted according to the parallel fundraising scheme. And so we started raising money. And we started, so somewhere at the beginning of September, let me check again. Yes, it was around the 10th or so that we started fundraising, and this is what my calendar looked like. Basically, we scheduled calls with all the investors as tightly as possible. The more packed, the better. And this whole period was active fundraising. There were tons of calls, and more calls. Here, things were already winding down, but here it was still active. By the way, here too, and here as well. And somewhere from the second half of November, we were just following up with those who were left, and by December, there really wasn't much going on anymore. So we started in September, asked all our acquaintances to make introductions for us, and as soon as the intros came in, we started scheduling calls. I started attending these calls, meaning I was doing this full time. My partner, meanwhile, was running the business, so basically I was the one handling all the fundraising during this period. So in the end, what did we end up with? Initially, we had some warm introductions that our close friends and other fellow founders kindly made for us. Then, in addition to those, we also proactively sent out a whole bunch of cold applications through various websites. I'll show you those briefly in a moment. We actually sent tons of detailed applications directly to the official websites of many different investment funds, because there are quite a lot of them out there. We reached out cold on LinkedIn, wrote emails to all these people, to everyone. I'm showing everyone we wrote to, in other words, thousands of people. We sent emails to 1,000 LinkedIn contacts. There are a lot of them, cold emails, and this is the message we sent them. This is our blur. Blur. It's like a short description of the startup. So when you ask someone to make an intro, most often they ask for a blur, like, what is this all about? And you send them the blur. So in the end, we actually got between 60 and 70 different calls. And we successfully managed to close about 4 separate deals, or something along those lines. Yeah, we did not actually end up raising a massive amount of money, but it is certainly enough for us to keep things running for about a year. So what else should I talk about? So yeah, you join the call. How do the calls go? You join the call, it's a video call. Why is it important to be in the US? Because the first question is, where are you located? And you tell them, I'm in San Jose. If you tell them you're somewhere, I don't know, in Amsterdam, well, that immediately raises questions. That is, local investors want to invest in local startups. What is a local startup? It's a startup that, well, has a legal entity in America and whose founders, or at least some of the founders, are located in Russia. Oh, in Russia, in the America. So, as a very brief summary, usually the way I structured it, I would then ask them to talk about their fund, and they always talk about their fund. You need to find out what their check size is, how they make decisions, what their usual process is, how many calls they usually have. Then you move on to the pitch. So during the pitch, the way I pitched was I would show them the specific way that I pitched back then. I would show them a full 2-minute demo video about our latest product. Let me show you everything very briefly.
Easy.
Vision. Use it. So here we are. Yes, showing it. I showed our video demo, but I won't go into detail about all of that right now. Basically, I showed them the video demo just about our product. Essentially, it was the demo we used in sales, so that they could generally understand what the business does in 2 minutes. After that, well, then I would tell them more. Then they would usually ask some questions right after that, and yes, that's when the questions start. The usual questions are, who are your competitors? How is your solution different from the competition? What kind of traction do you have? What are your plans for the future? What makes you unique? Why? How much money do restaurants save with your solution? There are a lot of questions like that. I can't remember them all now, but that's the general type of questions they ask. How much money are you raising? How long have you been working on this? And so on. So I didn't really show anything during the calls. I didn't really show anything on the calls. I didn't use the pitch deck. we had a pitch deck, but I didn't really show it. Sometimes I would show it if I needed to present certain slides. I would send everyone a one-pager in advance. This one-pager, the one-pager. Basically, it's a very brief pitch deck where you put in all the best things you have. For example, we had signed contracts, we had pretty significant traction, and we had a strong team. And after the call, I would send them the data room. Here's our data room, and here, market analysis. Here we have, well, kind of our plan for the future. Here was our funnel for, I can't show it right now. Anyway, the sales funnel was here, and we also had a competitor analysis, but I can't show that either. There. Basically, it was a table like that. We had feedback from our clients. We did. But I'm too lazy to go in and deal with the financial documents right now. Basically, there were some documents like Excel spreadsheets with projected revenue and projected expenses. I sent all of this to them after the call. I have arrived now and I will attach the files. I will attach them right away. The recording, I recorded all the calls, almost all the calls. I recorded them and sent them to our team. I sent them to the mentor, the startup guy who was helping us, sent them to my partner, collected feedback and sometimes transcribed them. I put this into the G5 chat so that, any English mistakes could be corrected, or if I was reporting something incorrectly. And also I just listened to them myself, trying to figure out what could be improved. So the weakest points in our pitch were as follows. It was quite difficult to articulate the bigger picture, the so-called big picture, where all of this is heading, because, well, in reality, we didn't actually have one at that time. I mean, we couldn't really paint this cool visionary picture that in 3 or 5 years this would become something truly incredible, like a second Google. Objectively speaking, we just couldn't do that, and that was a major weak point. I think that was definitely one of our primary weaknesses. After all, the logic of local investors here is that they're not interested in getting just a 10 times return on their initial investment. They want to get 100 times that amount. That is, they want to invest a single dollar and get $100 back in return. And so their logic is quite clear. If even in theory it's not entirely clear how this thing could become a massive unicorn in 3 to 5 years, then in practice it was also hard to pull off. Sure, we wrote things down, we had some roadmaps for how we'd reach 100 million in annual revenue, but we just couldn't paint that kind of rosy picture. That was the first weak spot. The second weak spot was the niche itself, the topic itself. So the most common feedback we got was that restaurants are a lousy niche, that they're very fragmented, that their margins are small, that they're very poor, and don't have any money. And honestly, that's exactly how it is. Right now we're thinking about what to do with all of this. Maybe we should look for pivots, some side directions, because as it turned out, restaurants really are a complicated and quite challenging market. And it really is hard to sell to them. For me, it became clear that local investors here are professionals. They really know their stuff, they understand a lot of different niches, and they get the specifics. I mean, seriously, these people have been doing this for years, they're professionals, and overall they catch on very quickly. They could spot our weak points right away, so you can't just fool them or pull a fast one. But we also had our strengths. We had a product, we had clients, we had revenue, we had reviews, all of that. And we had a strong, capable team. All of this worked in our favor. Plus, when it comes to raising investments, on the one hand, yes. Here, in a way, it's all very simple and easy to do. Well, relatively speaking, if you're a Stanford graduate or if you graduated from some other good university here, yes, it's easy for you to do. If you have some successful startups behind you that you've already built, then it's also easy to do. But all these stories, these are exactly the ones that many people have probably heard. Yes, like someone raised money just based on a presentation, I don't know. $2 million, $5 million. Most likely that's one of these two scenarios. Either it's someone who already has previous experience with successful startups, or it's guys with a strong local background, I don't know. A Stanford graduate, for example, yes, For him, it's actually quite easy to attract investment for his startup, even if he doesn't really have much traction yet. Traction is basically some kind of result. If you're an immigrant from Russia or any other country and you don't have any previous startup experience here in America, then raising money is not the easiest task. You really need to have a good idea. The idea is truly important, and you need to have some understanding that this could actually become a big story. You convey this understanding to investors so they see that this could become something big. And there also needs to be some kind of result, some traction, some clients, some revenue. I would say that the combination of these factors is crucial. Why parallel fundraising? Why do you need to get all the investors together as tightly as possible and try to do it in a concentrated way? Because as usual, you have a call, you talk and talk and talk to them, then they say, "This is super interesting, everything's great." They always say that and then they disappear. And then you need to, but most often they just disappear. Sometimes, yes, they're really interested, they immediately schedule the next call and you keep going. But in most cases, most investors kind of go off to think about it. And to make sure they think about it, to nudge their thought process in the right direction, you send them follow-ups. So you write them follow-up emails with updates, either about how your round is going, how your fundraising is progressing, or updates about your business, for example, like we've brought in 3 more clients. Or for instance, this guy has invested in us. And because you have a lot of news, because you have a lot of calls, say you had 50 calls and 1 person invested, you immediately get the opportunity to send a follow-up to everyone else and a few investors. That's exactly how we closed it. In other words, 1 guy invested in us. I sent out a blast to everyone like, "Look, this awesome guy invested in us. Let's go. We're closing the round soon, looking for more." Because of that, another guy invested, and then everyone who had invested in you, you immediately asked them to introduce you to their entire network, meaning all their investor acquaintances. So that you're now in the same boat, right? They're also interested in your success, so they start introducing you to their friends, other investors. You get even more calls, then you blast all of them again, and so on. So, yeah, that's right. So after a significant amount of time has passed, after you've had a call, most often the next step is what's called due diligence. This is the process where they check your revenue. They might ask for bank statements, or they might ask you to connect them with your clients to make sure you're not lying. So basically there's this minimal check, or maybe it doesn't even happen at all, honestly. So after that, they transfer the money, of course at early stages, and investors talk about this too. It's very important that in general the person likes you, so to speak. At early stages, this really matters quite a lot. There are still a lot of unknowns at the early stages, how things will go, whether they'll work out or not, so personal likability really is important. You need to meet with them. You need to try to just build normal human relationships with them. Overall, if they like you, that's a good thing, because people want to work with and invest in those they simply find pleasant on a human level. This is an absolutely normal phenomenon. And that's why being a pleasant person is good for attracting investment. As for, this is how, generally speaking, I would go about it. What experience I've managed to gain, what advice I can give. Probably, if you're not in the US, then the best way most likely is, and in fact the only way that I think is really possible right now to attract investment to build your startup is through accelerators. There are about 24 different accelerators in the US. Accelerators are simply programs that recruit startups, take a small equity stake in them, and then help develop the startup and attract investment. It's a very good way to build a network, get introductions to potential investors, and generally boost your startup. So accelerators are really an awesome thing. You can apply to an accelerator from anywhere in the world. You should indicate that if necessary, you are willing to move to the US if you get accepted into the accelerator. And if you do manage to get into an accelerator, that's the best possible scenario. You'll get a network here, you'll get introductions to potential investors. The chances are much higher than without accelerators. Just coming to the US on your own, as we actually did, doesn't really give you much of an advantage. We had a network of founders, our acquaintances and friends, and that's exactly how we managed to get over 100 intros there, which is actually a lot. So we had startup founders, our friends, mentors who have been here in the US for a long time, who have startups, some at the series stage, some at later stages, and they have a large network. Honestly, I don't know what we would have done if we didn't have that network. It's hard to find investors here, it's really tough. Yes, some people manage to do it if their topic is interesting. If you have a compelling idea and decent traction, then it's possible to make it happen. But for us, despite all the traction we achieved, our cold outreach had very little success. Out of the thousands of messages we sent, we got very few calls from cold outreach. And those were only with potential investors. So another option is, for example, if you have 3 people, 2 are focused on the business and 1 person. He works full-time the whole year, depending on how much money you have, or for half a year he just works full-time on investor outreach, writing to everyone, meeting everyone, getting to know everyone. He connects with other founders, meets other investors, he asks them for feedback, builds relationships with them. He tells them that we're planning to raise money in about 6 months. So now, that's exactly what we've done, and that's just it. Full-time, he's building this network from scratch. It's really a whole job in itself, it's a separate thing, it's not easy. Well, that's also a possible option. Overall, the experience was really cool. I personally enjoyed it a lot. It was my first experience ever raising investment. And, well, first of all, we raised some money, which was already cool. I mean, people actually gave us money, and, well, it wasn't a lot by local standards, but still. And it's great that we managed to build relationships with all these investors. So the next time I come to them to ask for investment, they'll already have a better attitude toward me, they'll know me and so on, which is great. Yeah. Yeah, and there is one more important thing that I really wanted to mention, which is that making these intros, well, you definitely need to help each other out and support one another. I mean, startup founders really are a community of people where it's customary to help each other, so in general, make introductions. If someone asks you to make an intro to an investor, go ahead and do it. It only takes a little of your time to make an intro, but it can really help your colleague. I've already made several intros myself. Funny enough, through the intros I made to investors we had talked to, the guys managed to raise several $100,000. In fact, through my intros, the guys have already raised more money than I did during my own fundraising, which is pretty cool. I was honestly really happy that I was able to help someone out. So that's basically how the whole thing went down. Right now, we're not raising any more money. We're working, focusing on traction and thinking things through. What should we do next? Maybe we'll also explore some related areas, see how things go, and yes, we'll keep growing and working. That's probably it. Thanks, everyone.